Hi, this is Mike Maloney. I was just looking through the news on my own website today, goldsilver.com, and there is a repeat of a story that we did last Thursday. This was about Stan Druckenmiller, one of the leading hedge fund managers and investment gurus. He's loading up on gold now and saying that the bull market in stocks is exhausted. And the article that was posted today is a much more in-depth version of the same article and has a lot of quotes from his speech. And there's some charts embedded in it. And one of his contentions is that if a certain set of fundamental structures were in place to create the great bull market in stocks of the 80s and 90s, this is the S&P 500, which is the 500 largest companies in America from 1966 until today. And what you see is that from 1980 until the year 2000, that was the great bull market in stocks. And now we've just been chopping sideways with a very increasing volatility, and it's been a dangerous couple of decades during this century. The last 2 decades of the last century were spectacular for stock investors. And then that is set against the 5-year Treasury. So what you see here is and then below that you see the total credit market debt as a percent of GDP. And what he's saying is if high interest rates that were falling year after year, descending interest rates, and low levels of debt, this is 1980, compared to the size of the economy, where you could borrow $1 and get more than $1 in return of growth of GDP. If that was good, and this is now nearing exhaustion, it's very difficult to grow the economy by borrowing currency now. So if that was good then, there was another thing going on. The PE ratios were very low. Back here in 1980, the PE ratio of the S&P 500 was down at around 7 times earnings. The price was 7 times how much that company's earnings were per share. And today, we're up at 18 and higher. So if these 3 factors, interest rates that were declining year after year from very high interest rates, low PE ratios and rising, and very little debt to GDP and rising were good for stocks, how could the inverse be good today? So this article is very important for people to read. Another thing that he looks at here is the use of corporate debt, that it wasn't used productively in this whole century here, since the year 2000. Non-financial firms' use of debt, 1995. I wish this went back further than 1995, because you only get a very small glimpse here of what is normal. And back here you can see a normal mix of what these different colors are. Is the dark green is the accumulation of cash. The purple is buybacks and acquisitions. So it's companies using debt to, instead of increase their cash position, or this light green, invest in capital expenditures. That's investing in plant and equipment and so on. So instead of using that for debt, the purple is used for acquiring other companies or for buying back your own stock and increasing your stock price by you being the customer of your stock. When you see this go negative here, this is they accumulate cash during some periods of time, and then cash is spent during other periods of time. But what you see here is that after the crash in 2000, things changed. This is the whole run-up to the real estate bubble here, and companies were using debt to buy back their own stock and to acquire other companies. And then we get into what has happened since the crash of '08. And what you see here is that it's almost all purple, very little capital expenditures, very little growth of cash on their balance sheets, very little of borrowing of currency to just have it as a backstop for your company, for liquidity. And then he talks about the Chinese zombie lending, that it can't stop. Bank assets to GDP and nominal GDP growth. China embarked on a huge stimulus program, and what you see here is that for every dollar that they, or not dollar, but the renminbi, but for a certain amount of currency that they would borrow, they would get a very high degree of GDP growth. But that has changed to where their GDP, the more they borrow, the less growth that they have going into the future. This reflects something that has gone on in the United States for the past 30 years also. We used to get quite a pop in GDP for each dollar borrowed, and that has diminished actually since the 80s. So this is a very important article to read. Stan has been more right than he has been wrong. So I encourage you to read it and take a look at his conclusions, because I think that there's something very large coming down the road at us. And his conclusion, what was the one asset you did not want to own when I started Duquesne Capital in 1981? Hint, it has traded for 5,000 years, and for the first time ever, for the first time now, it has a positive carry in many parts of the globe. Now, what he's as bankers are now experimenting with the absurd notion of negative interest rates. So what he's saying there is one of the things that people used to use to bash gold, to say that gold was bad, was that it doesn't produce a cash flow. It just sits there. There's no income from gold. Where if you buy bonds, they have an income. They cash flow. They've got a return. Well, now a lot of the world's bonds are negative. They charge you to have them. And that means, by comparison, gold has a positive carry now. It's something that does pay returns simply by the fact that it doesn't pull money out of your wallet, where bonds can. Some regard it as a metal. We regard it as a currency, and it remains our largest currency allocation. So he's going more into gold and less into equities. So thanks very much for watching this. I encourage you to read this article about his presentation that he gave, entitled The Endgame. And if you got anything from this video, please like it and share it, and we'll see you next time. Thank you very much. This video was brought to you by goldsilver.com. I'm proud to say we've been one of the most trusted dealers for over a decade now. We have fast, free shipping and a price match guarantee. While our competitors serve you ads, we serve you education. And that's the difference with goldsilver.com. To learn more, click the info button. Thanks.